a book that's going around in our circle and also Front Row Dads and a bunch of business groups I'm in is who, not what. And so I want to go back to this idea of like, hey, a sponsor can save a shitty deal and turn things around. A good sponsor, a bad sponsor can screw up a pristine deal that should have huge returns. So, I imagine most people come to you and say, well, what deals you got? What properties are you buying? What's the rate of return? What's the operating agreement? But it sounds like to me, what you're saying is like, hey, it's more about Andrew and their team and the who are going to put the deal together and manage it than whether or not we're buying 200 units in Georgia or 400 units in North Carolina, because the who is going to be so much more important than the what. So can you talk to that a little bit? And I know you're not good at self-aggrandizing or patting yourself on the back, but can you tell us why the sponsor is so important? Because in my mind, I'm like, well, if you buy a 400 unit property, 10% under market, like who could fuck that up? But everybody. Okay, perfect. Okay, so that's the story I want to hear. How does the who affect this so much?
Yeah, so I think that the best way, one of the easiest ways to maybe illustrate that, if you buy a $300,000 house in your standard, track home development, you can fix it up, you can, make it nice, you can, however, but when you go to sell it, the value of that property really is going to be determined by the comparable sales in that neighborhood, right? If all the other houses sold for $350,000 and you overspent and put $300,000 of work into an awesome kitchen and all this, you might get a little bit more, but you're not going to be too far above $350,000, right? In the commercial world, and especially in multifamily, the properties are valued by the cash flow coming off of it, right? What determines that cash flow? How well that property is being operated. So when you listen to podcasts and you hear the gurus and the boot camps and the books, everything is focused on how do you get that deal, right? Because that's exciting, it's sexy, and until you get your first deal, you don't have a business. So there's legitimate reason for that. But the real money in apartments is made in the operations, the asset management and the property management. Because when you go to sell, your property isn't valued. Yes, people look at the sales comps as a point of reference. The appraiser is going to look at that. But how it's actually valued by the market and by the buyers is they're going to take the cap rate in that market, which is, that's not it. Basically, it stands for capitalization rate. And look at what that really is cap rate is a measure of market sentiment, right? So if we say a cap rate is 10% in one market and a cap rate is 5% in another market, generally speaking, the lower the cap rate, that means investors have a higher level of confidence in that market and assets in that market. So if you're selling a low cap rate, the lower the cap rate, the better, right? And what happens is you take your cash flow and divide by the cap rate for that type of asset in that market, and that gives you your valuation. Okay, so if you have I'm going to try to do math on the fly without having finished my coffee, so we'll see how well this goes. If you've got a $100,000 a year net operating income, okay, which
so this is profit on the building, $100,000 profit on the building.
Cash flow not factoring in the mortgage and depreciation, right? Because that's mortgage and all that's finance and accounting. That's not the property, right? So people are concerned about what kind of income stream can I get from the property, regardless of what kind of debt I put on it. So if you've got a $100,000 a year net operating income and you're in a market, and if you find one of these markets today, let me know. But if you're in a market where the cap rates are 10%, right? You're going to take that $100,000, divide it by 0.1, which is 10%. Valuation of your property is $1 million. Okay. Now take that same $100,000 cash flow and move it to in that same asset and put it in another market where the cap rate is 5%. $100,000 divided by 0.05, that asset is now worth $2 million. All right. So that's how properties are valued. So looking at it from another way, let's say you buy a property where the cash flow or the net operating income is 100,000 and the cap rate is 5%. So you just say you bought it for $2 million. If you can get in there and over, I don't know, a 5-year period, operate it well and figure out how to get that net operating income up to 200,000, and let's just say cap rates stay the same, you just created $2 million, because now $2 million divided by 0.05, I'm sorry, 200,000 net operating income divided by 0.05 is a $4 million building, right? So that's why, unlike the single family, in apartments, the operator is the key, because how well they understand the markets, understand the asset class, how well they underwrote it in the first place, and the people they put in place to run the day-to-day, those things are going to determine that cash flow. And that cash flow is going to determine how successful of a sale you have down the road.
Now, I think this is public information, so I'll ask the question. You can tell me if I need to shut up. On that $50 million property that you bought a year ago, was that a year ago?
That was in March of this year.
March of this year. It was either that one or another one that you've acquired in the last 24 months. You guys went in there, you cleaned it up, you used your economy of scale to get the expenses down and the revenue up, and now your cash flow is better. You shared a success story of a building that you bought for X and appraised for X like within a year or two. Was that this building that recently had a large jump in value?
It might be. We've got a handful that fit that description. So I'm not sure specifically which one you're referring to, but I can use that one as an example, because we actually just looked at the valuation yesterday. So that particular prop, and I can talk about this because it's closed and no more investors can come in or anything like that. So we purchased that for 49.8, and in the 6 months that we've owned it, our average rent increase now stands at $408 per unit. Now it's 250 units, so we haven't gotten that. Not every unit is up 408, but the ones that we have, done a light renovation on, are up on average $408 a unit. So so during that 6-month time frame, we've increased the net operating income. Also, by choosing the right market, Fort Walton Beach is a very strong market, huge population growth, strong median incomes, low crime. We're not in a flood zone, a whole bunch of the things that we look at. So we bought an asset in a market that gave us a strong tailwind. So we have greater odds of success, lower execution risk. And then by getting in there and bumping the rents that much, when you combine how much our net operating income has gone up with where the cap rates for that asset is today, if we were to sell it today, it would sell for between $70 and $73 million, right? And we bought it for 49.8 6 months ago. And we're not, we're probably only 25% of the way through increasing that net operating income, because we have a whole lot more units to renovate and turn. Did we underwrite that well? Yes. Did we pick the right market? Yes. But part of that's why picking the right market makes such a big difference, and that's why it's important to have, as a sponsor or someone who's buying properties, to have a disciplined approach to where you buy, because it increases. I mean, it's easy in one sense. Hey, we got lucky, right?
Right.
But by buying that way, it increases the odds that you're going to get lucky.
Right.
Right. I cannot say, I did not predict we were going to get $400 rent increases. We predicted 200. I think it was 270. Right. So we actually got it wrong. We underestimated it. But because of the way that, one is, the market shifted for everybody and we're all benefiting from that. And I can't take any credit for that. But part of it too is by being in a market that benefited even more than average, it increases your odds of doing that. So again, it gets down to, back to the original question of, you're really betting on a sponsor more than a deal. There are attractive looking properties in all kinds of horrible places, right? So you're betting on a person who knows how to pick the right property in the right market and then operate it well during the hold time. And, that's really what it comes down to.